Hey, what's going on, guys? Welcome back to Insights Jose. Time to give you my insight for today. So today's topic is going to be on how to become a long-term investor. But before I tell you all my tips and tricks, I got to tell you a brief story on why I decided to become a long-term investor and why I decided to join the market. So for all my new subscribers, if you didn't know, I actually recently just separated from the military during the summertime of 2019. So when I separated, it was a series of unfortunate events and none of it was planned. So like how I was saying, none of it was planned, it legitimately wasn't. Unfortunately, I lost all my benefits from the separation. But before the separation, like while I was in service, everything was good. Everything was gravy. Let me just give you an insight on how good my life was going. So I had just gotten married to the beautiful Mrs. Lopez. I was in a position for me to rank up, which is basically in civilian terms, it was for me to get a raise. So I was right there to get, I was in competition for me to get my rank up, which means more money. And if you're on my channel, you know I love money. I had about like what, 2,000 around there. It was like in the low 2,000s. That's how much I had in my savings account. So I thought I was good back then. And then to top it off, I had just bought a brand new 2019 Challenger. I was like, ooh-wee. So think about it, you know what I'm saying? I got me a wife. I got me a brand new car on the way. Well, actually, I got me a wife. I got me that brand new car. And I was actually in the process of getting approved for getting a 2-story house on base. Like, you can't tell me my life wasn't going smooth. So basically, my life was good. I'm telling you, a lot of people wish they could have been in that position. And I used to want to be back in that position. I used to. But now that I look back, I had no investments or assets, which is the number one thing that I messed up on. That by far had to be the worst mistake of my life, by not having no type of investments or assets. And let me explain why. So the day I got separated was the day I realized I was being very irresponsible and very dumb. But only for that moment though. It was just for a temporary thing. I had just started to realize what was happening with my life the second I got separated. My life went from having a place to live with my wife, brand new car, a steady stream of income, to boom, in the snap of fingers, in the snap of my fingers, my life just switched. Immediately to no job, no source of income at all. Now I have a monthly payment for a brand new 2019 car. I have no house. Like my life went from amazing to trash. Kind of like the stock market at times. So I need you to understand it like this, okay? So I was at my brand new job and I'm just sitting there. And I'm just sitting there and I'm thinking, I'm just like, damn, my life went to complete heaven to crap in seconds. So I have from a steady stream of income to me sitting there and I have minimum wage. And then my job was providing slightly above minimum wage. So I'm just sitting there, I'm like, what the fuck? So I'm telling myself, no way am I gonna have a boss tell me what I'm due till I'm 50 or 60. Then for me to retire just to have 3 years for me to do whatever I want. You mean to tell me you're willing to work 50 to 60 years for you to just live the last 3 years of your life? To me, and the way I look at the stock market and stuff, that does not sound fun. That does not sound beneficial to me in my life at all. To me, I'd rather have it the other way around. Maybe even I could retire at the age of 30, but like I said, hashtag millionaire by 2030, we're gonna get there. Not just me, but you, because you're gonna start investing, because I'm about to give you all the knowledge today. So I went to Google and I looked up how to become a millionaire, right? Just like anyone else. I got a lot of options, so I just kept reading and reading and reading and reading and reading until I ran into long-term investing, and that just, like that, a light went off and it said you have to do it. So like I said, I just looked up what comes with being a long-term investor, and then boom, I'm telling you, it got me. So I'm going to tell you all the benefits of this being a long-term investor. But before I make it seem like it's all easy and it's all fun and stuff, it can be easy if you know how to implement it correctly. Well, not necessarily easy, but it can be a lot more fun and a lot better for you to understand. So yeah, the stock market can be very tricky and complicated. But if you can get a good understanding of the ins and outs of the stock market, you can make a fortune. So if you're on my channel and if you're not aware and you kind of don't know anything about the stock market, I'm gonna bring out like kind of general knowledge, okay? So you have your short-term and then your long-term investing. Both methods can work and they both have their advantages and disadvantages, but I'm just here to tell you about the advantages long-term investing can bring to you as what it brings to me. So like what I was saying, both methods do work, short-term and long-term, but in my opinion, I truly believe that the short-term is very stressful. Don't get me wrong though, the long-term investing can be stressful too, but if you were to do a comparison, I would much rather go with the short-term being the most stressful. The reason why I'm saying that is because they have to stay alert at all times and they can only focus on what's going on now. They necessarily can't think ahead because they had to make sure it's working for them now, okay? So like what I was saying, their main focus is the present. It's not necessarily the future. So that can always keep you on your toes 24/7 because you always got to be in the now, right? So if you're always got to be 10 toes and you're always looking for the present, you're always going to be stressed out, which is going to bring a lot more stress. But if you were to compare that to the long-term investor, you necessarily won't freak out if the market's so volatile. If it's going up or down, it doesn't matter because you're in it for the long run, right? So when I say the long run, I look from 2 to 6 years out. That's the time frame that I personally have for my stocks. When I read all my information and when I do all my research, I'm telling myself that XYZ stock is gonna double, triple, quadruple in the next 2 to 6 years. So I want you to get that mindset as well. I want you to be thinking that, all right, I'm not here for the short term. I'm not here for the first year. I'm here for 2 to 6 years. I'm holding this stock for 2 to 6 years. Why? Because I believe it's underpriced and it's gonna make me a fortune in the future. And then another benefit when it comes to long-term investing, you actually save more money when it comes to taxes compared to a short-term investor. The reason why I'm saying that is because for long-term investors, if you were to hold that stock for a year or more, you get taxed at a 20%. So you would get taxed 20% rather than if you're a day trader, you would be taxed roughly around the mid to high 30% range for your for all the profits that you sell. Another benefit to long-term investing is if you start to find good stocks that give good dividend payouts, you're gonna start receiving checks from that company, which is cool. Now I just want you to imagine you have 6 different people giving you money. That, my friend, is how you get rich. You see, the rich only get richer because they have multiple streams of income. They don't rely on that one source. That's what I want you to do. I want you to get multiple streams of income. There's a reason why on one of my recent videos, I have 5 ways for you to make money. The way for you to become rich is to have multiple different streams of income, okay? I need you to understand that. The other benefit about long-term investing is if you smash the like button. I'm sorry I had to throw it in there, but please, if you can for real, smash the like button, share it, it'd be cool. Now, I'm done with my story. I'm done with all the benefits. Let me tell you on how I invest long-term. So my goal is gonna be for me to make this as easy and understandable as possible. So if you have any questions, you have all my social medias, and if you don't, it's on my header. Just if you got any questions for real, like let me know, ask me, don't be shy. No question is dumb. No question is gonna be uneducated. I'm here to tell you everything that I know. And if I don't know, don't worry, I'm gonna get the answer and I'll bring it to you pretty soon. All right, cool. Now let's get into how I invest long term. So the first thing I need you to realize, and it's pretty obvious, but it goes over a lot of people's heads. I need you to realize that you're in control for you to decide when you want to buy or sell a stock, okay? I need you to understand that. So the reason why I'm saying that is because in the stock market, a lot of people tend to get other people's opinions and they value it more than theirs. I want you to realize at the end of the day, I'm not smarter than you and you're no smarter than me. The only difference is I just do a little bit more research at the moment, but I'm about to give you all my knowledge. So basically, I need you to realize you can't value other people's opinions most of the time. It's okay to have an open ear to listen. Open ear, not closed ear. Open ear to listen, but at the end of the day, don't underestimate your opinion. Your opinion matters so much that you don't even know, and the reason why you don't know is because you've been listening to other people's opinions. You need to focus on yourself. You need to focus on your own thoughts. If you think that this stock is going to be amazing because you did all the good research, then by all means go for it. I'm not going to knock you because of your own opinion. At the end of the day, it's your stock portfolio, not the other person's. Value your opinion more than the other person or the person near you. Let's go to some basic words that I think are vital for you to know. And I'm gonna be using them pretty often throughout the channel. So you got bull, bear, stock, EPS, which is gonna be abbreviated for earnings per share. Then you got earnings, and then PE. PE ratio is what I mean, PE ratio, okay? So the bull market is gonna be when the market is going up. With the situations that are going on right now, it's about to go all the way to a bear market. So if you can kind of go ahead and just tell what I was trying to implement is you got the bear market, and the bear market is when there's a 20% drop into the market from its highs. So stock, also known as a share, just know that every single time you buy a stock or a share, just understand that you are literally getting part ownership of a company, okay? So you're getting part ownership of that company. That's the reason why I say you need to value your opinion more. This is your hard-earned money that you're gonna put into this company, right? Into whatever company you have, the XYZ company. This is your hard-earned money. You're the captain, okay? You're that head honcho, and you're gonna be the one that was a terrible salute. I'm sorry, I haven't been in the military in a while, but you're the head honcho at the end of the day. So you need to act like you're the CEO, all right? It's kind of a bad example, and I really hate to knock it, but it's kind of like this. I want you to see yourself as those ROTC people or the explorers that think they're cops because they're going through the program, but they're not necessarily there. That's kind of like how it is, but not that bad. Like, you're literally part ownership, which is cool. You own that company. So EPS, earnings per share, is the calculation method that shows how the company generates income and profits for each outstanding share. So then PE ratio is going to be what is the price versus the earnings and what is the ratio of that. So a 20 and under for a PE is actually pretty good. The lower it is, the better. The reason for that is because that could indicate it's an undervalued company, which is what we like. We like to buy companies that are undervalued, so when we purchase them, and then once Wall Street starts realizing how good they are, their price is going to go up, and then that's when we sell out. Okay, kind of basic concept, but let's go back to what I was trying to tell you. All the PE ratio indicates is just the perception from the investors. So the investors are going to see it as which PE ratio is lower, and whichever is lower is going to signify that it's technically cheaper. I want you to think of it as price. Look at the PE ratio as a price, because not many people can understand the other method. Think of it as a price. The lower it is, that's the cheaper company that you're going to want to buy. At the end of the day, you want to buy cheap companies that are going to be very, very beneficial, right? They're cheap because they're undervalued. So the lower PE ratio, that could indicate, I don't want you to get it mixed up. The lower ratio could indicate that it's undervalued. We won't know until we do our research, okay? So now that you know the basic knowledge of the common vocabulary that I'm gonna be using, let's get straight to the fundamentals. So the fundamentals are easy, like they're so easy. The only thing is that it requires work. That's the reason why the single stock pickers are starting to fade away very slowly, because not many people are willing to do that work. When it comes to stock market investing, honestly, it depends. It all depends on you. It depends how bad you want the money. If you really want it that bad, you're gonna be reading 24/7, you won't find an excuse. So what you're gonna do is you're gonna look up whichever stock you're interested, right? XYZ stock. You're gonna go ahead and go to Google, and the first thing you wanna do is you wanna make sure that's a public company. You wanna see if it's public, and if so, how far, when was it public? When did it become public? If it's an IPO, I'm sorry, that's another vocabulary term. If it's an IPO, initial public offering, I usually tend to stay away from those just because they're still very new to the market, so not many people can predict where that's gonna go, and then you can come up with a bunch of fake numbers, okay? So when it comes to the IPOs, I tend to stay away just because they're still very, very new, and I just can't trust very, very new companies. And I'm still somewhat new to the stock market, so I'm not that confident for me to go to IPOs. By all means, if that's what you're comfortable with, go for it. Let's say your company is public. What you're gonna do is you're gonna look up XYZ. XYZ is gonna be the example. XYZ Investor Relations, okay? You're gonna look up that Investor Relations. It's gonna send you to that website of whatever company it is. That Investor Relations page is all meant for you because you're that investor, okay? You're an investor. Now that you're in my space, you're an investor. I don't know why I did that. Wakanda. Yeah, so now you're an investor, okay? So the first thing you're gonna wanna do is look for that 10K, also known as an annual report. That annual report, that 10K, it's extremely vital. That's gonna tell you everything that's been happening within a year span, basically the most recent things that's been happening within that year. First thing they're gonna tell you is the business model. Or unless there's a proxy statement. A proxy statement is just gonna be like the CEO giving a statement of what's going on, or if they're gonna hire new people to the board and stuff like that. The first thing you're gonna read is that business. You wanna read that business sector. The reason for that is because you wanna see exactly what that company that you like, you wanna see what it does. And if you like the way it's operating so far, then continue reading. They're gonna tell you the risk factors. Do not miss out on those. Those risk factors are very vital. I'm gonna tell you right now, the first investment that I did not go so good because I skipped through half the risk factors. And what got me so hurt, I'll tell you which stock in a minute, but what got me so hurt was the fact that if I were to have read the second risk factor, I could have saved myself a good $2,000. I'll tell you the stock a little bit later on. Yeah, so you're gonna want to read that 10K. You want to read the business model. If you like the business model, continue. Then they should be talking about risk factors. Read through every single risk factor. If you think that your gut can tolerate all those risk factors, then by all means go continue reading. They should be talking about litigations. They'll be talking about their consolidated income statements, cash flows, balance sheets. Those are extremely vital. When it comes to the balance sheet, you want to make sure they're profitable at all times, okay? You want to make sure that the ratio from assets to the debt, you want to make sure that the assets are above. The reason for that is because you want a profitable company. Unless that business model that you read and you know it's going to be money in the future, unless that's the case, then you just want to stick to the fundamentals, okay? The next thing I would recommend is to go immediately to the board of staff. You want to specifically look up the CEO. And with that CEO, just look up all the interviews that they had with YouTube. If they're a big CEO, you'll be able to see it. And the reason for that is because you're going to want to see if you like that CEO. You want to see if he represents not only himself good, but the company. If he's representing himself and the company good, that's a good sign, because that's indicating that CEO not only cares for himself, but for the company. You want the CEO, the main boss, to care about that company. Because if you don't care about the company, what makes you think that CEO will? The next thing you want to do is look up all the presentations and see what are the nearest events that are about to come up, and listen to the conference calls. The conference calls, if you don't know what that is basically what the CEO is talking about in the last quarter, so there's 4 quarters in a year, right? So you're gonna get that conference call at least 4 times, and they're gonna be telling you what's been happening in the quarter, if they were profitable, if they miss earnings, why they miss earnings, what do they expect in the future, all that stuff. All of this is all accessible for free on Google. That's what's amazing. That's why I love stock market investing. And the best part is because there's no commission fees at the end of the day too. I'm so blessed and so lucky that, and you're so blessed and so lucky that you're in the time where there's no commission fees. So you don't got to be paying every single time you want to buy a stock or sell a stock. You don't got to pay that commission fee. You're almost in a recession. So this is the time for you to like make history. All the people that were rich in 2009 and 10 was because they took that step and took stock market investing seriously when the recession happened. That's why a lot of good long-term investors are still very successful, is because they take these type of opportunities and they take it to their advantage. That's what I want you to do. So then if you looked up the 10K, if you read their 10K, you read their 10Q, you checked all their, you listened to all their conference calls, you saw all the interviews with the CEO, and if you like that business, right, all of those are a yes, I would highly recommend you buy. Only if you believe that's gonna double, triple, or if you think it's gonna go higher in the long run. Only if you think so. At the end of the day, it doesn't hurt to get someone else's opinion, but if you believe it, why not trust yourself? So that's all I got for today. Thank you for joining Insights of Zay. Until next time, peace.